Hi, I'm Brian Arcese, Portfolio Manager on the Foord International Fund and Foord Global Equity Fund. In what was exceptionally well received by markets, perhaps overly so, inflation began to abate as the base effects of the Russia-Ukraine war-related energy and food price shocks and lockdown-related global supply chain constraints continued to normalize. Global equities rebounded as the relatively modest deceleration in inflation was met with the best monthly equity performance of the year, November alone increasing 7%. Our outlook for global developed market equities is not as sanguine. The realization that inflation not only remains high, but has also seemingly taken hold in the services component may well weigh on markets in the months to come. Markets ended 2022 with uncertainty, cementing the worst year for stocks since 2008. Bonds underperformed equities as both asset classes posted annual declines for the first time since the 1960s. Global growth expectations remained lackluster. Over the quarter, rising global interest rates, persistently hawkish central banks, and elevated geopolitical tensions weighed on risk-taking. Our U.S. recession is becoming increasingly likely, with the Conference Board now forecasting 2023 real GDP growth of 0% year-on-year, compared to previous expectations of 1.5%. A bright spot for markets and our portfolios was the rapid reversal of China's COVID-0 policy. Chinese bourses rose 37% and have posted their best two-month return in years. These tailwinds are likely to continue in 2023, as government stimulus, coupled with inexpensive valuations, creates a constructive combination. The fund returned 8.4% for the quarter, with both asset allocation and stock selection contributing strongly to returns. The fund's largest asset class during the period, equities, contributed the most to fund returns. In particular, fund holding Freeport-McMoRan, a global market-leading copper miner, contributed most as shares rose on the back of China's departure from previous COVID-0 policies, on the expectation of increased demand. Additional Hong Kong-listed securities, including market-leading insurer AIA, and property developer Wharf Holdings contributed strongly. Detracting from performance were the fund's short S&P 500 futures positions, owned for hedging purposes, which underperformed in a rising market. Over the full year, the fund held true to its conservative mandate, both protecting and growing capital. During 2022, the fund grew 3.4% against a global developed market equity decline of 18.1%. 2023 will no doubt be volatile, with much dependent, as was last year, on inflation and the pace and magnitude of central bank tightening. We look forward to taking advantage of the expected volatility both between and within asset classes, while remaining ever focused on delivering real, inflation-beating returns through the cycle for our investors.